Good morning. You're watching The Market right here on ET Now with me, Asha Faridi, Nikunj Dalmia, and it's finally Friday. Although we've managed to put on a good show in the last 5 trading sessions. But yes, yesterday it was a little of a wobbly session. We managed to close in almost lower by about 1%. This morning, though, things are not looking up at all. You've got the global cues, which are clearly not supportive. In fact, the weak global cues are weighing on our markets, and banking stocks have weighed heavy on Wall Street as well overnight. You had the US jobless claims hit a 10-week high, and that's clearly not going down well with the markets. Asian markets as well have been trading weak as we speak right now. In fact, it's a sea of red all across the screen. Cuts of anywhere between about 1 to 1.5% is what you're seeing on the Asian screens, and the SGX Nifty as well, indicating to a downtick of about 1%. And I guess, Nikunj, what we were discussing up until the earnings season, which is the more immediate trigger and cue for us, the markets are going to just fall prey on a daily basis to what happens globally.
It's actually back to old days.
I was thinking the same thing during the opening shot. Yes.
Yeah.
Yeah. Back to just you and me.
Yes,
today.
yes. Those were some days.
Yeah.
But it's back to global cues again for markets. Look at the red on the screen. 1%, 1.5%, 2% for Nasdaq, and 1.5% down for Brazil. So obviously, you will start gap down, and the gap down start for the market is largely because of global cues. Now, I can argue back and say that India has underperformed this year, so the impact of global cues may not be that large, and it may not last after a gap down start because foreign institutional investors have come back. The narrative for global markets, in a sense, has got challenged, especially after the Fed commentary and what we got in terms of the US job data. So Fed now will be forced to maintain that inflation is a concern, US economy is growing, and they will have to storm the growth. So that becomes the global narrative. The India narrative is slightly different because Indian markets have underperformed. FIs who were selling, now they are coming back, and in general you would say that a lot of concerns in terms of high valuation and froth in the small and the mid cap stocks, that gets challenged. But I think you will be in for some disappointment, Aisha, because just when it appeared that markets were getting ready for a step up, it's going to be back to square one, which is one step back, one step forward. I was hoping that this time it would be 2 steps forward rather than 1 step forward and 1 step back. So it's not alarming, but it is a very annoying feeling if you're a trader that you don't know which way things are moving. That's the way it is.
Yeah, it's going to be a tough market to call, and it's going to test your patience for sure, as it has been from the start of the year up until now, or actually post, the budget. But I mean, look at the contrast difference, right, Nikunj? Because on one hand, you have Fed, which is talking about tightening, and the BOJ is saying that they're going to be adding to easing without hesitation, while they do see uncertain times ahead, but the rates are at negative 0.1%.
Yeah, unfortunately, that's the way how things are. You look at what is happening in China, slow down. You look at what is happening in US. The jobs market are vibrant, inflation is strong, but layoff has started in some of the high tech stocks. So it's not a very easy market to call. Sometimes you can call a bearish trend also. Sometimes you can really call a bullish trend also. It's a very difficult market to call. And in this kind of a market, you again say, don't trade, don't take large positions. Volatility is going to be extreme. I was hoping for more constructive action for benchmark indices because mid and small cap stocks had just come out of their hibernation, so to speak. But now this price action, in a sense, is going to make everyone nervous. Till the time you don't see few days of decisive trend move in benchmark indices, markets are not going to give you any kind of a flourish, so to speak.
Yeah. But truth be told, valuations are still not looking as cheap. Yes, it's going to test your patience, and it's going to be extremely difficult and perhaps a no-trade zone for a long time for traders. But for investors, what changes? Yeah, things are still looking okay. Barring the Adani group of stocks, nothing is really changed.
This is what happens when you know your co-anchor from 10 years. You read my mind. Now, I was just thinking through it. Look how I see things, or what I've, in a sense, understood when I speak to some market men. Number one, the direction of Indian economy is headed higher. If you spend a lot of time in a range, which is what we've done, let's say from December to about March, the earnings are getting added up. So the size of the earnings pot is expanding. Market had run up too fast and too quickly in 2021 and 2022. So they are going through time-wise correction. We've seen time-wise and price-wise correction, but earnings are still growing, which means that for another quarter or another 3 months, if you don't go anywhere, suddenly the markets will look cheap and we will start focusing on FY24 and FY25. So directionally, I think this is that grinding time where you need to just stay put. In equity market, returns are never linear. We've always discussed that. In equity market, you will always see more like a ECG of a heart. You will see that kind of a return. Returns will never be linear. But if the economy was contracting, which it is not thankfully for us, then you would have argued and said that the best is behind us. But the best is yet to come because economy is expanding, earnings are growing. What are we debating? We are not debating growth. We are debating growth rate and we are debating valuation. Now valuation, because of 2 quarters, we've not gone anywhere. They will look cheap, and if earnings they come up, suddenly the markets will rotate again. That's my view.
Right. Okay, let's just, throw some light on what the global talking points as well are this morning. We have Ed Yardini joining in right now. Ed, hi, good morning and good evening to you. Thanks for staying up for us. Just wanted to understand the US jobless claims at a 10-week high and clearly not going down well with the street.
Well, I think at first, when the initial unemployment data came out, it showed that there was a slight increase, and the bond market and the stock market greeted it rather well because we're now rooting for bad news because good news is bad. We're rooting for a slowdown in the economy, a slowdown in the labor market, so that the Fed doesn't continue to raise interest rates. I think what really hit the market hard was, of course, the sell-off in the banks, which was related to the SVB bank problem, as well as some more problems in the cryptocurrency market.
Also throwing light then, Ed, on what Jerome Powell's commentary was. Pretty hawkish, one would say, and it doesn't seem like, the Fed is quite done with the interest rate hikes.
Right. Well, it seems as though every time he speaks, he kind of, one time he seems more hawkish, the next time he seems less hawkish. Back on February 1st, when he gave his press conference, he mentioned the word disinflation several times, and everybody concluded that he had turned less hawkish. It seems as though he's kind of changing his tune depending on what the latest set of data says. I hope the Fed kind of sticks to its commitment to raise interest rates to a reasonably restrictive level, keep them there, and then let them work. It's going to take some time. The Fed has actually said that on a consensus basis, they would like to get the inflation rate down to 2% in 2025. I think that's very reasonable, but they shouldn't panic here with every single economic indicator and move more aggressively than they've already said that they would.
Yet I look at the jobless data and then I compare with what the US major tech companies are doing. They are in a process of layoff, whether it is Alphabet or whether it is Apple or even for that matter Facebook stroke Meta. So one side the US economy is losing high-end jobs, but the labor market conditions are still not looking sticky. They're still vibrant. So are we looking at the real relevant jobs data?
Well, it's a very complicated job market. We certainly are hearing about lots of layoffs in the tech industry. And by the way, they're global layoffs, so it's not all in the United States. And the other thing is a lot of those people who are losing their jobs get a severance package. They get some money when they go out the door, and so they don't immediately go and file for unemployment claims. And some of them may very well find a job very quickly because they have skills that are still needed, maybe if not in one company, then in another company. Where we're seeing a tremendous amount of demand for labor is in the hospital and healthcare sector, and of course in the food services sector. I think some of this may actually be related to the aging of the baby boomers. The baby boomers are getting older, they're retiring, they're moving into retirement homes, and they don't like to cook for themselves. So there's been a tremendous increase in demand for restaurants, and as a result, we have a shortage of restaurant workers. And the same thing goes for the healthcare system. the baby boomers are kind of overwhelming the healthcare system, and there just aren't enough employees to satisfy all that demand. So some of this is demographically related, in my opinion.
Oh, yeah, it sure is. Ed, great to have you on the show. Thank you so much for taking the time out and joining in. Well, whatever may be the reason, after that employment data or jobless data, which is coming at a 10-year high, the equity markets are not taking that down too well. Down about almost 1% for the SGX Nifty as well. And after yesterday, that sharp fall which came in for our markets in the last lap of yesterday's trading session, snapping the 3-day winning streak for the index. And autos, clearly, they were the ones which dragged quite a fair bit, while metals just marginally managed to lend support for us. You are seeing some fresh shorts in the Nifty and long unwinding when it comes to the Nifty Bank. But let's also take a look at, the Tata Tech IPO. That is something, of course, that we're going to be talking about. It's a hive off from Tata Motors. But HDFC Bank, that's on our radar. It's a big interview coming up. And the HDFC Bank CFO, it's the first TV interview ever.
First TV interview ever, and it's coming at a time when, in general, markets want to know about the merger, how it will go through. B, what happened to their website? What happened to their website a week ago? I mean, what are they doing to get their technology in place? Because HDFC Bank, in a sense, has suffered with a lot of tech outages. But more importantly, I think it's growth. For a bank of that balance sheet, if it is growing at 15 to 18% plus, and if they're able to mobilize a lot of CASA, is HDFC Bank now getting ready for a next move? A lot of MSCI concerns have been addressed, but at a time when other banks are struggling to get low-cost deposit, which is also known as CASA, what is HDFC Bank doing slightly differently? Now, we're going to play an excerpt of that conversation. It's a big exclusive on ET Now today on HDFC Bank and the way forward.
The beauty of this place is that the macro is that the consumer credit is very low in the economy, right? When you have the consumer credit penetration 20 to 30%, 20, 25%, that is, so you have a long runway for consumer credit to pick up, right? People aspirations have only gone up. People aspirations haven't come down. So if one has to be operating like a Western world in times to come, there's a long way to go. This has to double, triple to be at that kind of a level from a consumer credit penetration.
Sure.
So there's a long way from that sense.
I'm surprised that, there's also a point that your entity is being able to do it very well. But if you look deeper into the system, there are consumer durable companies which are telling us that some demand has, maybe you are mining your clients and your customers very well for the penetration part. I want to understand with you, there is a thought in the market about your bank, which has seen phenomenal decades of 20% plus compounding. And now the numbers show that at least the business growth on the top line front is kind of hovering around the 18% kind of a number. Whereas your NIM growth is very healthy, 24%, and many other parameters are upwards of 20%. So are we now seeing some moderation, and for foreseeable future, that's the new normal we are talking about?
See, if you go back, you have to go back in history to see what is the kind of rate of growth that we have experienced. You can look at any block of a 3 years or a 5-year blocks, right? A year or a quarter wouldn't tell you a trend, but if you look for a longer period, say 2012 to 17 as a 5-year block, 2.3, 2.4 times, essentially high teens to 20. That's the rate of growth, right? Assets or deposits. So you go back to 17 to 22, another block of 5 years, say 2.3, 2.4 times, 18, 20%. Or if you look at a recent time period of a year or so, this is a similar type of a 19, 20% type of growth. So that's the kind of, the velocity at which we are moving currently is faster than the velocity at which we were moving when we were 7 years, 8 years ago. So the larger we have got, the faster our velocity is. So
you will say that the best way to analyze the growth and velocity is actually look at a 5-year picture, not a yearly picture. Perhaps they'll mask a lot of growth there.
Yearly is important, but over a longer period is where you deliver a change, deliver the difference.
Hello, and it's going to be a wobbly Friday, not a tough Friday, not a scary Friday, but it will be a tough Friday. You know, Kunal, just when it appears that, okay, this is it, the Bulls have got a out of the jail card, somebody just catches them back.
No, but it was not a home run for the Bulls as it is, because even though we were going in through a patch of a rally, but we always knew that there was lack of support from large cap names. Until the time you don't have large cap stocks supporting, seeing a follow through up move, sectors participating, it's going to be a bit tough for the indices to hold up higher levels. So we were just expecting that possibly this move would probably take the index from 17,800 to 18,000 marks. That 200 points seems to have been missed out. But then the correction in the bank Nifty is what we anticipated. 2 days back, 41,700 to 800 zone was a huge resistance for bank Nifty. Also coincided with the 50-day moving average. So I think it doesn't come as a surprise, frankly, because the global cues have been a lot more jittery over the last couple of days. I think 2 or 3 days post the Fed commentary. So I think it doesn't come as a surprise that the markets are also going into some sort of selling pressure. Now, what matters to see is that whether the 17,400 mark, which has been an average or a good support for the index, holds up this time around, whether you see an intraday pullback or whether the markets came into the strong support zone. And if that happens, then we could be looking at a stronger phase of correction for the index coming back.
Okay, so let's look at the Nifty for a minute here. There is now yesterday's price action now becomes slightly dismissive, if I may say so. We sold off Kunal in the last 40 minutes of trade, largely last 1 hour of trade, if I may say so. Can I say that Indian markets preempted the global market fall because we were down already before global markets fell? So what you may actually see is that you may see a gap down and then markets could recover. I'm just being a contra observer
It
here.
may not even be a gap down.
It may.
Yeah.
Yeah, so I think maybe 120 to 30 points is I would say, decent enough gap down, so 0.8% on the index. But yesterday's selling started off on the noon for the indexes, and it was mostly the weekly expiry which was playing a lot of effect, because I was actually looking at the data. In fact, on the closing as well, I mentioned there was a huge amount of writing of the of the call options. So from 41,600, then 500, and then 400. So when you have call writers writing aggressively and lowering the strikes with every time passing by, it's an indication that how confident they are that the markets or the indices would not breach up higher and would not go into any kind of a strong intraday rally. And that's exactly what panned out throughout the day yesterday, especially from the noon. So I think it all depends on the data today back again. If there is any change of stance from the option writers, then we could probably change our stance as well.
Well, the Nifty, of course, only fell about 30 odd points in the last lap of yesterday's trading session. It was the Nifty Bank which fell harder. Rudramurthy, are banks looking like the weakest link right now?
Aisha, good morning. For me, banks were actually last 2-3 days kind of a performance which was altogether more outperforming than Nifty. But for me, what is very crucial is after the US market move yesterday, support now comes at around 40,600 on Bank Nifty future. If you observe yesterday, HDFC Bank was definitely holding out, and I could see that strong supports at around 1,620, 1,600 coming up. So for me, risk reward is now definitely not favorable to short banks. I will in fact use this gap down what we get today as an opportunity to buy. Let us be very clear, this market has now turned from sell on rise to buy on dip market. Even if you see Nifty 17,300, 17,350 has been a very strong support. And let me tell you, last 2-3 months we have always underperformed the global market, but now it is the time to outperform. Adani saga has more or less ended and market will outperform the global indices. So for me, every dip is a buying opportunity. Market has turned from sell on rise to buy on dip, and levels to be watched on Bank Nifty is no doubt we have that resistance at around 41,800 to 42,000. But once we decisively cross 42,000 on a closing basis, and also once Nifty future crosses 17,850 on a closing basis, we might move in this range, but I am positive and I use every dip as a buying opportunity.
You use every dip as a buying opportunity. Kunal on the other side is telling us a very different kind of an observation. Would you like to tell Kunal your observation? Kunal, would you like to tell CA that why you're looking at it differently?
So I think few days back we presented the bull and bear case on how the index goes into a round of 3 consecutive months of negative. Over the last 2 decades, there has not been 4th month consecutive negative for the index. But prior to that, 96, 98 as well as 2001, there were instances when there was 4th and the 5th month negative for the index, and the correction in the 4th and the 5th month whenever the index was negative has been extremely sharp. So it's always better to earn the cautious side. So I think it makes sense to be a bit more cautious in this kind of a market rather than being extremely optimistic.
But we have 21 more days to go, so hopefully things may not be as bad. Or does it look like it's headed?
See, we can always hope so that the worst may not play out. But then, we also have to look at the scenario playing across the globe. Fed coming out across, all of a sudden, the Dow started to get into a correction. I think if I'm not wrong, it's just some 50-100 points away from breaking its 200-day moving average Dow. And this has not happened over the last 2-3 months for the Dow Jones. And that could probably break the trend for many of the other global markets. So it may probably be a cascading effect for the global markets. Again, this is more to be on the worst or on the cautious side.
Okay, let's talk stocks then, and let's wonder whether there are any intraday opportunities that one can work with. Rudramurthy, what's on your list?
Aisha, for me, I'm picking NTPC as a buy candidate, and in fact, yesterday also this stock was outperforming, and I see power as a basic theme which can do very good. In fact, last week I was recommending REC, PFC and all, which have done very good. So it is now time for stocks like NTPC to perform. Looking at targets of 195 initially available in futures, one can use this gap down today to buy NTPC, keep a stop loss of 175 and an initial target of 195. And also Bharti Airtel was another stock which was outperforming in yesterday's market, and I can see open interest addition happening on the positive side, and stocks which outperform in a negative market are stocks which are strong, and I want to buy them today on every dip. So Bharti Airtel, look at initial targets of 810 with a stop loss of 760. And a very crucial index view which I want to present, where I agree with Kunal, but only thing is right now risk reward is not favorable after a gap down to short at current level. I'm talking at a trade opportunity today morning after market opens. I don't want to sell closer to the support zone of 17,350. Let us say we see a decisive break of 17,300, 350 zone and we close below 17,300. Then yes, I might say, okay, for short term markets are not good. We will follow the global cues. We may not outperform. We will go short. But I don't want to short after a gap down of 150 point, which SGX is indicating, and very close to support zone. That is a crucial point I'm making. Let us break 17,300 decisively on Nifty on a closing basis, then go short, but definitely not at current level after the gap down.
On your stock specific list then?
So I initiated a couple of sell calls yesterday. Would go with the same sell calls. First one is a sell on BHEL. So I'm shorting the strength for the markets, and the stock has been doing reasonably well over the last 4-5 days, rising up by more than 8 to 10%. So would suggest a sell on BHEL, targets of 75, stop loss could be kept at 80. And Manappuram Finance as well was one of the best performers over the last, I think 3 or 4 days, rising up to 118-19 marks. So would suggest a sell on Manappuram Finance, targets of 114, stop loss at yesterday's high of 119.
Okay, Kunal already accommodating some sell calls there. We'll take a very quick break. The news is that the SGX Nifty is hinting towards a downside of almost 1% to start off the day with. Let's see which way we head. Quick break, be right back with more. Well, the Tata Group once again is going to be in focus this morning, while of course we are prepping in for a gap down start. About a 1% downtick is what the SGX Nifty is hinting at, tracking the global cues this morning. The Tata Group is going to be IPOing after a gap of almost 18 years. Remember, the last IPO from the Tata's stable was TCS. Tata Technologies is going to be listing soon. Now, it's a subsidiary of Tata Motors. They filed for a DRHP as of yesterday. The offer for sale is about 23.6% equity. And part of it, of course, is offered by Tata Motors, part of it by Tata Capital Growth Fund, and part of it by Alpha TC Holdings as well. Remember, Tata Motors holds a sizable, almost 72.5% stake in Tata Tech as of March 31st. And Alpha TC and Tata Capital Growth Fund own about 8.9 to about 4.5% nearabouts, respectively. Tata Technologies, the revenue stood at about 3,530 crore rupees and profits at 437 odd crore rupees in FY22. And like I said, the last IPO from the Tata stable was in 2004, and that was TCS. So this is going to be an exciting one again. I mean, of course, not as big as a Tata Motors or a TCS. It's a hive off from Tata Motors.
So, why are they taking this company public? You could ask yourself this
Yes.
question. Do they really need the capital? I think they're taking Tata Tech public because it's a subsidiary of Tata Motors. So the proceeds they move into Tata Motors balance sheet. This is in line with the program what Chandra had shared, that we want to make Tata Motors net debt free.
But then
By
that's
2025.
just an accounting entry then.
No, Aisha, the money comes into the balance sheet.
Yeah.
So what happens is that when the money comes into the balance sheet, the debt reduces. That's one. Second, this is a technology company. Can Tata's, and the minute you come into the public domain, you will get noticed. And a Tata Group company which has
Will
an
never go
embedded,
unnoticed, yeah.
it'll get noticed with an embedded play on technology and design. Could this be the next Tata Elxsi for the Tata Group in making? That is something which minority shareholders would look at. Second, because this is a subsidiary of Tata Motors, eventually if the price of Tata Technologies in 2 years or 3 years goes higher, then the sum of part for Tata Motors in a sense changes completely. That's my sense. But from a market standpoint, I don't think this will have impact on the stock per se today, because markets knew this was coming. So the stock had already reacted to Tata Motors, this news, I think, when their intention was made clear. We looked at the sum of part numbers also. The maximum upside which was there was about 3 to 4%. That I think is getting fairly captured now. But this could be a promising IPO and a stock to watch whenever it goes public, considering that at Tata's, it is technology. So more than Tata Motors, I think on a standalone basis, this could be an exciting IPO.
And of course, in the near term, we'll have a bearing on Tata Motors as well. Chakri, hi, good morning. Glad that you could take time out and join us on short notice. We're just discussing the Tata Technologies IPO, a subsidiary of Tata Motors. How are you reading into it?
Good morning. I think clearly it's a positive, but it won't really move the needle much in terms for Tata Motors because, yes, the balance sheet will become stronger. So that's the good news. And it'll become more the sum of the parts will kind of reduce, which is also a good thing because when you value a company, it's easier to do so if it is in a single line of business. Second is the IPO in itself is a good thing. It's an attractive company. It's an area where there's a very growing interest in the US and in the advanced markets. So part of that can actually also at some point reflect back into India, into the Indian technology space, that is. So if you look at all these parts, it's a good thing for the IPO in itself. For Tata Motors, it brings in a few thousand crores into the balance sheet, makes the balance sheet stronger. But over and above that, I don't think it does anything meaningful for Tata Motors.
Okay. So you will not buy Tata Motors because of this news. Is that what you're indicating, Chakri?
Yeah, absolutely right, Nikunj. I would buy Tata Motors as a company because I think it's looking attractive. The balance sheet is becoming stronger, but because of the deal, wouldn't be the reason.
Every time when it comes to Tata Motors, I think, Kunal, you get ready. How much has been your holding period for Tata Motors? I mean, it's been 2 years, 3 years. What's been the holding
This is the
period?
third year.
Third year.
Calendar year, third calendar year.
Third calendar year. And you're a trend watcher, right? Trend watchers normally don't take calls which are based on quarters. It would be based on days and weeks. This is a yearly call.
No, in fact, traditionally I am a trader, so we look out for swing trades, 5% to 10%.
I'm trying to understand the logic. I mean, why are you holding a stock for 3 years?
But then there are few systems. There are few. So we also make portfolios for ourselves. So in that sense, we have a lot of stocks. So you would be surprised. We have Tech Mahindra at 187 rupees. We're still holding on to those kind of stock, and I've not seen the quantity as well. So
You can tell us. That's okay.
off air. But then, so I think that's what we do. There are times when we spot up some very class opportunities, and we don't want to miss out on those opportunities from a long-term play, and that's where we tend to latch onto these stocks. Those are very rare opportunities, but yes, whenever it comes out, we go all out.
So I'm guessing you caught Tata Motors at the COVID lows, right? That time it must
Not
be
exactly the lows, but 108 is where.
pretty much.
Yeah.
So, but at that time it must have been a problem of plenty. So why Tata Motors?
No, it was actually, in fact, it's very interesting, Aisha, because I think the low was hit on the month of March 2020 for the index. Tata Motors actually started to rally in the month of June 2020. So it was pretty late for the stock. And after 2 months of very strong rally across the board for the markets, when you have one opportunity where the entire market is moving up higher, and then there's one stock which is sitting idle, and you're like, the charts are glaringly very positive. So you can't miss out on that opportunities because you've missed out on the other opportunities on the larger side.
So you catch on.
So you catch on to this with full gusto.
COVID low, the market cap of Tata Motors had gone to like some 45,000 crore. The market cap of Indian Hotel had gone to about 9,000 crore. Just
It was at
unbelievable.
100, right?
Sub 100.
Sub 100.
65 or 70 rupees was the market cap of Indian Hotels. Let's look at it. Let's go back to, let's say, 2020, maybe June or July 2020 to see Tata Motors and Indian Hotels. Indian Hotels was sub 20. Tata Motors had hit sub 100 if my memory serves me right.
What a time that was. I was just thinking of those days when you used to see the market crash the way it did.
That's the way it is. Every 8-10 years you will get something which is
a black swan event.
Which is a black swan event. Now, in the last decade, it was GFC crisis.
Yeah.
This year, unfortunately, it's been COVID. This decade so far, I hope we don't get anything like that ever in our life. And then you get 2 or 3 mini crises. So, for example, a mini crisis in the last decade was taper tantrum. That's the time Indian markets got spooked because of the twin deficit.
Or policy paralysis.
Or policy
for us
paralysis.
in 2013,
Exactly.
yeah.
So that's how markets move. You get one large, extraordinary black swan event every 10 years. You get 2 or 3 mini sell-off points. And that's the time you have to just remind yourself that good news and good prices, it rarely comes together. So either you will get good price or you will get good news. The problem in India right now is that news is good and prices are bad.
But Kunal, are we heading in for that mini crisis if indeed March also is a negative month?
So the setup across the globe is indicative that there are things which are going to be a bit more wobbly than what it has been earlier for our markets. And it's been clearly observed by the trends for the US index particularly. So on one hand, Indian markets have been falling over the last 3 months, but there is no major correction across the major developed markets like Europe, etc., where these indices are making new high. But then the concern across the US markets is something which is ringing the bells for possibly some sort of a correction which could be brewing into the global markets back again. So I think it's always better to be a bit more cautious in this kind of a scenario till the time the global markets don't bottom out, and specifically the US markets.
Okay. Chakri, I'm going to shift gears and talk about what's been keeping you busy this year. Where have you shopped? Where have you taken some chips off the table? What have you exited completely?
This has been a very volatile year with constantly changing news. And I think, the discussion on US is very relevant from an Indian perspective because, constantly the data in the US is proving, the labor data is proving to be constantly stronger than expectations. Economy is still strong. The Fed doesn't have any other idea other than increasing interest rates, which again, the market is believing should not do so. So in this battle, I think the curves have inverted. In fact, Indian yield curve has also inverted, which is not good news because it is telling that the economy is slowing down, which means consumer spending will come down. The capex will also go down. So I think this is a market, therefore, needs to be very diversified because and it has to be a positional market because the news is constantly changing.
What do we have on the editors' radar today? Stock number 1 is Grasim. 2 factors why Grasim is back on everyone's radar. We are starting actually with Grasim here, so let's look at Grasim. First, the commentary from the management about the core business, which is VSF. So Grasim is a holding company. Let's remind our viewers here. They have stake in Ultratech and a lot of other Birla group of companies. But the core operating business of Grasim is the VSF business. They are sounding upbeat about the core business. Now that's one business where they pretty much have a almost like a market leadership and almost like a monopoly status. That's a business where the operating leverage for Grasim I think is going to be huge, because if demand picks up, that means we are looking at strong operating leverage kicking in for Grasim. Grasim has also indicated that they would be incubating a large paint business where they're talking about a 10,000 crore bet. Now, first markets thought that it's going to be 10,000 crore of capex what they would be doing. The management has come out and said that the total investment outlay for Grasim would be 10,000 crore, which includes spending in brand, capex and working capital. That means in the near term, markets now will see a sign of relief, largely because the total capital requirement, and since the paint business is a highly competitive business and Grasim will have to spend first and then earn later, if the capital requirement expectations are getting reduced, that in a sense will change the near-term terminal value of the stock. So that's another factor which is going to be acting as a trigger for Grasim. Second, what do we have? Oil marketing companies. Now they are the ones where we've not seen any kind of an re-rating. Last year we saw massive re-rating in across the board PSU stocks, but because of high crude prices, oil marketing companies, they never got their bit. But now demand is down. In a normalized time, which is what we are right now, when the pass-through of energy prices and fuel prices is real, oil marketing companies are in for strong gains. I think that gain has been the missing factor. Petroleum product prices also have stabilized so far. So some would say that for a value-conscious swing investor or positional trader, there is merit in revisiting some of the oil marketing stocks, because crude definitely is in a decline. The petroleum product demand for oil marketing companies is stabilizing, and more importantly, the marketing margins where they were not allowed to increase prices because of political compulsions, now that seems to be normalizing. So after two bad quarters, we could be in for a decent quarter for oil marketing companies, and I don't think markets right now are pricing that in.
In fact, we're going to also throw light on the airline ticket trends and how the airfares have been panning out. But let's get you some respite from the heat, and the FMCG arm of Reliance Retail, that's Reliance Consumer Products, is now relaunching that iconic 50-year-old drink called Campa in an attempt to contemporize the drink for New India. It's been launched in 3 flavors, and the idea behind the launch, it seems, is to promote homegrown Indian brands which have deep connect with the consumers. In fact, Anurag Joshi, who broke this story first, joins in once again to tell us all about it. Anurag?
The iconic Campa Cola is making a comeback after a gap of over 13 years. Reliance Consumer Products, a unit of Reliance Retail Ventures, is seeking to launch Campa in 3 different flavors: Campa Cola, Campa Orange and Campa Lemon this year. It is a comeback of sorts for Campa Cola, which was last marketed in 2009 and was one of the key brands through the 1980s and 1990s. Initially launched in 1977 by Pure Drinks, it was one of the key soft drink beverages in India, especially in the pre-liberalization era, along with Thumbs Up and Limca. The entry of foreign firms like the Coca-Cola Company and PepsiCo in the 90s dented market share for Campa, which had to fade out by 2009. In fact, last year Reliance Retail bought this brand for 22 crore rupees and had unveiled plans to relaunch it in the market.
Okay, and let's get you some more fundamental ideas. Hear it out from Sanjeev Bhasin from IIFL Securities and what he's betting on.
I continue to see Bosch has hit new highs. By the way, 22,000 is coming. You can add a Motherson Sumi on the OEMs. And I think Eicher and Maruti will lead from the front. Bajaj is a very, very big outperformer along with Mahindra. But I think some of the OEMs can outperform from here.
All right, now Bitcoin has also sold off. So we have a proper risk off mood, so to speak. Where are 10-year yields? 10-year yields have not gone to 4 plus. Now we may argue about the dollar index and the positioning of the Fed, but at the peak the dollar index was 115. At the peak, the volatility, I mean the 10-year paper 6 months ago, US 10-year paper was way above 4. So we are not there. We are not there in terms of any kind of an global macro peak scare. The global volatility still remains very, very manageable. The problem is that how do you deal with today's gap down? And now it's getting, bad is getting worse, and worse is getting horrible. When we walked into trade this morning, it was 120 points down, 170 points down. Now suddenly it's 230 points down. So Kunal, it's going to be not a scary start, but it's going to be a big gap down today.
Yeah, it's going to be a big gap down, and I think it's going to be I would say a reasonable adjustment to the markets, because over the last 3-4 days the Dow had been falling very sharply. So I think the net correction for Dow in the last 3 days has been more than 1,200-1,300 points. So if you try and adjust that, then I think it's a good parity that our markets are also coming back to the lower end of the support. But as I said, that what matters now is that whether we go into a retest or the break of the previous major lows, which is just around that 17,350 odd mark for the Nifty. And if that happens, then that could probably be calling for some bit of more correction on the indices. So I think I would not be in a hurry to buy the initial gap down, even if the indices open up at 170, 180 points plus lower.
Okay, still in wait and watch mode, but airline tickets have seen a drop in fares, and a 7-day forward booking seems to be indicating that, while they have mixed trend in the 2-month forward prices. Let's take it across to Somit and find out which routes have seen these movements. Somit, where should we book our next ticket to?
Well, we'll definitely get to know this from this link. Now, we did check the ticket prices on March 9th, and we did it for 2 segments. First is the 7-day forward, which is the shorter and mostly done by corporates. And then there is a 2-month forward rate that we checked that was on May 8th. And this is largely done by general public for leisure travels. Now, what we have checked prices for the top 20 routes in India. And what we have observed here is that we have seen a drop in the 7-day forward fares. In fact, among the top 20 routes, if you see, 11 of the routes have seen a fall of more than 20% in their rates. And when it comes to the 2-month forward, we are seeing mixed trends coming in. Now, for 8 routes out of the 20 routes that we have checked, we have seen a drop in prices, while for the remaining 12, the prices have increased anywhere between 10 to 50%. Now, the routes that have seen the biggest drop in 7-day forward, that comes in Mumbai, Hyderabad, Mumbai and Delhi, Patna. Now, these 3 have seen a drop of more than 30%, while Mumbai, Kolkata and Delhi, Hyderabad have seen a drop of around 22 to 29%. Now, this is the 7-day forward rate that we have checked. Now, why this fall could have happened in the 7-day forward rate? Firstly, because airline companies might have passed on the benefits of lower ATF prices. Now, from December peak, if you see, ATF prices are down by around 8%, and along with this, Q4 is generally a seasonally weak quarter for an airline company, and to boost demand also, they might have lowered the ticket prices. Now, when it comes to 2-month forward, now we have seen a drop in 8 of the routes, and the top routes where the highest drop that we have seen in the ticket prices is Patna, Delhi, Mumbai, Hyderabad, Delhi, Chennai, where the routes have dropped by around 12 to 19%, while there is again Chennai, Delhi and Delhi, Patna, where the routes have dropped, prices have dropped by around 11 to 12%. Now, routes where the prices have increased, now there are 12 routes where the prices have increased, and the highest increase has been seen in the Mumbai-Bangalore route, where the prices have increased by almost 50%. When it comes to Delhi-Pune, the prices have increased by around 32%, and when it comes to Kolkata-Delhi and Delhi-Bangalore, the prices have increased by around 14 to 24%. Now, why the routes are trending, why the prices are trending higher for the 2-month forward rates? This could be because Q1 is a strong quarter due to holiday season, and airline companies also know that most of them pre-book their travels, and hence the prices might have been bumped up for the strong period that is the first quarter of financial year 24.
So if you're planning to travel in next 7 days, you should get a ticket done right now because fares have fallen. And if you're planning to travel after 2 months, well, there is no relief whatsoever because air prices actually have gone higher. So Chakri, you can choose 7 days, go to Delhi, come back. It's cheaper. But if you're planning for a summer holiday to Delhi, don't go.
Indeed,
Delhi in summers, Nikunj.
I mean, my mom and my in-laws are there, so I have to go as a compulsive factor. Okay, Chakri, tell us.
Yeah, so I think clearly what is telling us is this year holiday season will be a very strong one, and those trends seem to continue from last year, and and therefore the hotel companies now there's a mix of hotel companies because if you look at an Indian hotels or a chalet will have a combination of both business as well as leisure travelers, whereas if you go down to the Thomas Cooks and the Mahindra Holidays, it's largely leisure travelers. Now, these companies have corrected fairly significantly on interest rates, all kinds of fears, but the holiday season seemed to be turning out to be fairly strong. So I think looking at some of the travel companies like hotels is a good thing.
Couple of other stocks which are going to be in focus, and Nikunj was just highlighting Grasim, so that's of course the stock that we're going to be looking out for. Tata Motors, considering the subsidiary Tata Technologies, has filed a DRHP with SEBI for an IPO. There's MGL as well. Brokerages are pretty positive post the management commentary coming in on the Unison acquisition. There's of course BOB as well, which has now approved divestment of about 49% stake in BOB Financial Solutions. That's going to be the other stock to look out for. And then IRB Infra as well as the IRB Invit as well. IRB Infra, the February toll collections have seen a good jump up both on a year as well as a month-on-month basis, standing at an uptick of nearly 26.7% year-on-year. And month-on-month, though, there's been a bit of a downtick, about 6.25% or so. IRB Invit as well. That's the other one which is going to be in focus. Home First, we reported this yesterday, and Fidelity Funds and Nomura Fund have bought shares via block deals. That's what the data, suggested. So that's going to be another stock to look out for. And then Gokuldas Exports as well, wherein Aditya Birla Sun Life and Ashoka India as well as GS Funds have bought shares in the block deals yesterday. So these are a couple of stocks which are in focus and on our radar this morning. But Kunal, yesterday you couldn't really take out a defining trend, but one thing that did stand out besides what was going on was with the Adani group of names, Reliance, a big crack on that stock, down 2.25% yesterday.
Yeah, that's the struggling part for the markets, because whenever you want the markets to lift off, Reliance doesn't participate, and when the markets are actually crumbling under some selling pressure, Reliance is one of the first ones to participate on the downside. So that's a bit of a dichotomy for the markets, that Reliance is moving into a trajectory where it's showing more weakness rather than more strength for itself. But then, in terms of chart patterns, we will just wait out for one confirmation point when the stock breaks below the 2250 mark, which has been the previous month's support for Reliance, from where the stock has bounced off. So till the time the stock holds up above those levels, we can assume that these corrections would probably get absorbed into, and the stock may be a bit more resilient. But if that 2250 level gets broken down, then the prospects change quite dramatically for the stock, and we could be looking at a much more sharper correction coming in that stock as well.
2359. Chakri, why is Reliance, despite their businesses which are firing full cylinders, is now massively underperforming the market?
I think, as you rightly put, all their businesses are doing well, and clearly their largest business. Now, in terms of their spreads, with such volatile, oil and gas prices going for the rest of the year, that can kind of put a little bit of uncertainty in forecasting and EPS, but still, which means it'll make the quarters volatile. Second is, this overall uncertainty thing impacts their retail business, all their consumer-facing businesses. And third, it's one of the largest stocks, which is also held by an FII. So whenever it comes to reducing India positions, Reliance is among the first stocks where the weights are.
Grasim, Nikunj was highlighting, that's the other stock which is in focus. Their global peer, that's Lensing, has really upped their outlook, and in their commentary they're saying that they are going to clock in bumper sales. Stocks along the value chain are now normalizing, it seems, and given how strong the commentary has been from one of the largest players in the global industry, this of course will augur well for Grasim as well. Now for Grasim, of course, VSF contributes to the large pie for their revenues, which is viscose staple fiber, and I'm guessing that's something which is similar to cotton used in apparel, Nikunj, considering you do understand the apparel industry. And looking at the sales that Mango, Zara, everyone's clocking, I'm guessing there is clearly more demand.
It's actually used in blended fiber.
Yeah.
So
Fabric.
fabric.
Yeah.
Yeah. So it's a blended fiber which they make,
Yeah.
and that's actually eventually used in fabric.
Yeah.
But Grasim, I think, has a almost virtual monopoly of this business.
Yes.
And the reason why they have a monopoly is because traditionally this is a business which requires two things: a lot of water and a lot of paper pulp. And Grasim's manufacturing and the entire manufacturing setup is such that they have access to water and they have access to the raw material and the paper pulp. So not paper pulp, actually wood pulp, if I may use the word. So that, I think, is a huge advantage for them. Now Grasim, remember, is a holding company. Grasim has investments in Ultratech. They have this VSF business, which is a core business, and now they're incubating their entire paint business, where they're going to be taking Asian Paints and the Berger Paints head on. Now the challenge is that when you're making a large capital outflow of about 10,000 crore, it's going to be a business where you'll have to pay first and then you'll get the money later. So in the near term, the balance sheet and the return ratios for Grasim will get compromised. But the management has come out and said that, look, we are looking at investing 10,000 crore in the paint business, but that is the totality number. That is not just a capex number, which means that includes the money which we'll be spending in brand building, working capital, everything else. So the total net outgo is going to be significantly lower than what markets were projecting, and that, I think, in a sense, is going to be having impact on the underlying stock price per se. Chakri, I've always argued that why a stock like Grasim is not getting its due. It's got fantastic businesses which are incubating in its balance sheet.
Indeed, I think the holding companies, as we know, always carry a discount, and that holding company discount is there in Grasim as well. And in terms of capital allocation, for a holding company, they keep changing depending upon the company's preferences, where they say demand, etc. And therefore, in assigning values in your sum of the parts is always a problem. And second, as you just mentioned, now their paints business is a business which everybody is getting into, large corporates, simply because previously you had 2 or 3 players, strong margins, and that's the reason they got in. And now margins are going to come down dramatically with competition coming in. And combination of now, of course, general uncertainty. I think it's the holding company discount is the number one factor.
Okay. Let's get mid-cap ideas from Rudamurthy and from Kunal. Rudamurthy, what's there on your radar?
Nikunj, for me, REC is looking very good, and the outperformance what it has given can continue. It is just a choice between PFC and REC, and I'm just picking up REC here. If I see charts, 125, 126 has been that breakout level, and REC, having taken support at levels closer to 110, is now moving at the upper band. So if it makes the decisive close above 125, stock is headed towards levels of 150. So I will be a buyer at current market price, and on every dips like today's gap down, I will buy REC, looking at initial targets of 150, eventually 180 to 200 is possible. Keep a stop loss of 118 for this long call.
Okay, just checking out the pre-open rates, and it's a lot better than what one would have anticipated. That, of course, is the rupee opening, but we're down only 0.3% actually on the index, which is not all that bad as opposed to what the global handover has been, or for that matter, what the SGX Nifty was also indicating. But Kunal, what about your mid-cap ideas before I take a call on the index?
So it's on the buy side. I'll go for a buy on Ujjivan Financial. That stock is looking quite strong. It's a very relatively low to moderate beta stock over the last many months. The stock has been trading sideways. It's surprisingly holding on to its long-term averages as well. So I would expect that the stock can probably absorb the correction and move up higher. Buy with a target of 304, stop loss at 275.
Okay, let's just revisit what the pre-open rates have settled in at, because there's a bit of a, dichotomy when it comes to the Sensex and Nifty, and now you're seeing some normalcy kick in. About a 0.5% downtick is what the pre-open rates are settling in at. Quickly want to see what Tata Motors is up to after the Tata Tech IPO getting filed, and whether or not you're seeing any reaction come by. Maybe not. Tata Motors is still, you still don't have the first rate, or maybe it's just started off flat. But there's BOB as well, which is going to be in focus. So just look out for what that stock as well does. They've approved the divestment of 49% stake in BOB Financial Solutions. That stock mildly lower as we speak. And then I want to see Reliance, because that was a rank underperformer yesterday, as was Adani Enterprises and M&M. It was only the metal names which actually fell, fared okay. So maybe a Tata Steel, JSW were the only sort of saviors, along with an odd Bharti. But let's tell you what else is happening outside the world of markets. And shares of Silicon Valley Bank plummeted a whopping 60% after announcing a $1.75 billion stock sale, pushing market cap to just above that $6 billion mark. Now, the move dragged other banking names as well. The S&P 500 bank tumbled 6%, the biggest single-day decline that it has seen in about 2 years' time. And some good news for music lovers. Apple is on track to launch a new music streaming service that focuses on the classical genre. Now, this is after their 2021 acquisition of the Amsterdam-based streamer Primephonic. The new Apple app will provide access to more than 5 million classical tracks, curated playlists, and several exclusive albums as well. I'm waiting to see what the price is going to be on this. I'm sure it's going to be a paid one for free ad service. But other events to track out today, all eyes are going to be on the US-India commercial dialogue with a view to set new trade and investment opportunities as well. Ahead of the meet, the US Commerce Secretary Gina Raimondo and India's Finance Minister Nirmala Sitharaman also discussed a slew of other things ranging from India's G20 priorities to bilateral cooperation as well. And United States American Tower Corporation, or as we know it, the ATC, has taken a $411 million impairment charge after its largest Indian consumer, that's Vodafone Idea, indicated inability to resume full payments towards contractual obligations. Now, company has instead said that it can only continue making partial payments for now. Also, India's e-commerce major Flipkart co-founder Binny Bansal is in talks with payments aggregator PhonePe to pump in about $100 to $150 million. The transaction, if successful, will be among the largest individual investments made into a new age tech firm. And after a dismissal to respond to Marvel's latest Ant-Man, which has logged just about $420 million after a 3-week stand at the box office, Disney CEO Bob Iger has questioned finally the Marvel Universe sequels, says that he wants something new out of the MCU universe. Iger also says that it's now time for newness from the franchise.
Okay, pre-open rates, what do we have? The pre-open rates are not looking that scary. Let me put it this way. Rupees at 82.11. The pre-open rates are not looking that scary. It could reverse. These are pre-open rates and they can really change. But what is important is that we've now rushing to the lower end of the range. What have we seen in the last 7 days? Again, that same range-bound grinding move continues. Not here, not there, not up, not down. Sometimes you get a good day and then a good day is followed by one bad day. But the minute you get 2 bad days, you get 2 good days after that. Nifty range from 1st of March to now, and look at the range, has been in just a 500-point band. So from 1st of March, the market, despite global news, despite what has happened in terms of the FI trend has been stuck in a range. I'm not saying anything new, but that's how the market has been. The low point has been 17,250. The high point has been almost 17,800. So Kunal, now can I say that the first port of call for a trader is that watch for 17,300. If 17,300 remains intact, then you again play for a bounce. But don't do anything before that.
Yeah, absolutely right. So it doesn't make sense to be adventurous in this kind of a market, and always and also not preempt that the markets would probably get into a bounce just because we've fallen, or we would be probably falling by 150 odd points and coming closer to that 17,300 levels. So there are internal patterns. So the Nifty doesn't bounce by itself. It's the stocks as well as the sectors which bounces first. So you have to always look at the market internals, what kind of patterns shape up for the stocks and sectors. If the stocks and sectors be a bit more resilient than the indices, then we expect that the markets will also hold on to the support. So those are the factors which I think one has to watch before trying to jump as well as preempt that whether the Nifty would hold on to a support or not.
Okay. On that note, let's also get going on the index calls and tell you what the index positioning is as per our chartists. And Kunal, of course, maintains that don't trade the Nifty just yet. Rudra is recommending a buy on the Nifty, whereas Kush Bora is recommending a hold. So it's pretty divergent, all the Nifty calls coming in this morning. Similar to picture for the Nifty Bank as well. Rudra says that buy the Nifty Bank. Kush Bora is saying hold it. And Kunal again is saying that don't trade it. So I just want to highlight, Uday Kotak has commented on the overnight developments as to what transpired with, the US banks. And he's saying that overnight developments in US banking, markets, analysts, investors underestimate the importance of financial stability of the balance sheet of a bank. He's saying when interest rates move up 500 basis points from zero within a year's time span, an accident was waiting to happen somewhere. Now, we only hope that the accident is not as grave and there are no casualties and just minor injuries. But yes, that 60% fall that we had on one of the banking names and the cascading effect that it had on the others is not sniffing good news.
But Aisha, I'll give you the contra logic, which is that look, interest rates have gone higher, and we almost saw a scary sell-off, let's say 6 months ago, when the bond yield suddenly went up from 2.5% to 4%. It just happened in a matter of 3 months, and that's the time when you, in a sense, everyone got suspicious about Wall Street firms and what their ability to risk management. We've also seen a big crypto meltdown. When you see a large meltdown in the crypto space, of course, some casualties will happen, but you've not seen a systemic risk. That is something which I think we should feel very relieved about. There's nothing to feel happy when there is a meltdown in financial markets, but at least you should feel relieved about. Similarly, in the Adani saga, question marks were raised that, the lenders, Indian lenders, and the ability to pay up, and what will happen to the risk management, what will happen to the Adani group of companies in terms of their debt repayment. But I guess that fear has not become a contagion. I guess the same applies for Wall Street as well. The risk management this time around by Wall Street firms is uniquely different after having learned from the 2008 crisis. But when you see interest rates moving higher, it will have an impact. It will surely have a casualty here or a casualty there. We've seen that happen to, let's say, in the crypto world, when the crypto sell-off happened, what happened to some of the crypto exchanges. And if the risk management in this case is compromised, because nobody expected interest rates to go in this linear manner in a matter of just 18 months from less than 1% to about 4% right now, even 5% in some categories, it will have an impact on the financial market per se. But thankfully, it's the fear of contagion which every time comes when interest rates they move up in a hurry. That, in a sense, this time has not become an ugly reality, and I hope it does not become an ugly reality, because markets are not prepared to deal with any kind of financial contagion right now. Markets can digest if there is an asset price adjustment. Markets can digest if there is a change in terminal value. Markets can digest if in the near term there is a markdown in assets. But markets find it difficult when there is a contagion, and when there is a contagion, good stocks are sold because of compulsion, not because of an underlying compelling reason. 1.5 minutes to go. Let's look at the big setup. Setup number one. Wall Street last night spooked. Bank stocks have sold off. The US jobs data is indicating that US economy is looking strong. The Fed is maintaining that interest rates are likely to remain high, and they will remain high for an extended period of time. Second, we closed at the lowest point of the day yesterday. Did Indian markets preempt the Wall Street sell-off? We'll figure out in next 60 seconds looking at the gap down open. SGX was down, which means that there is going to be a casualty for sure in the initial bit of trade. Fourth, you do have a case that commodities have sold off and oil marketing stocks may start outperforming, considering that the winter is over and the peak oil demand globally now seems to be settled. So is there a case for oil marketing stocks to again make a comeback? So these are 4 or 5 talking points which in a sense are going to be the mood points today. We don't have any large newsmakers. We don't have a big calendar event today and tomorrow. But in general, I guess it's all about understanding what the right level of the market is. 15 seconds to go. It's not going to be a very happy Friday. That's what the initial rates are indicating. I really hope that we settle at lower levels, because all attempts of any kind of a pullback in last 10-15 days, they've run into some kind of a resistance. First rates, any second now. I'll do the screen, do all the talking. All right, there you go. 158 points down for the Nifty. It's a gap down start, and the market breadth is completely dented. So there is only red and only red on the screen, at least in benchmark indices. For the Nifty also, the same story continues. For the mid-cap index also, the same story continues. So there is hardly any green on my screen, with the exception of an Adani green. Maybe it's the word green which is looking strong for Adani green, but Adani green is the only green which I can see on my screen. Now you've got NBCC, which is up by 1%, just a coincidence. Yes Bank is down by 2%. You don't have any large stocks which have seen a lot of collateral damage, but not a good start, guys. Not a good start.
Let's check in on what Tata Motors is up to. You know, the subsidiary Tata Tech has filed for a DRHP. Tata Motors marginally higher, 0.5% in the green. So giving Adani green, that company. Tata Motors 534 is where that stock is. There's also MGL. Brokerage is also pretty positive post the management commentary on Unison acquisition which has come in. There is Zydus Life as well, which has filed a final US FDA nod for erythromycin tablets. So that's another stock which is in focus, holding up 0.7%. And I'm focusing on the positive news right now. We'll come to the losers in just a bit. Wipro as well. The Menzies Aviation has selected company to transform its air cargo services. So a sizable order coming in there. But I'm not quite sure whether Wipro will be seeing any green this morning or not. That stock will just come off you on your screens. Yeah, predictably so. It's down 0.7%. IRB Infra, a bit of a mixed picture when it comes to the Feb toll collections. Year on year, of course, they're looking up, but month on month, there's a downtick of 6%. Absolutely flat for IRB as we speak right now. By the way, yesterday was the Maharashtra budget, and today is going to be the Punjab state budget. And Maharashtra budget has proposed almost 5,000 EV buses. So that's quite a bit of push actually coming in. So maybe the likes of an Electra, JBM Auto, etc., something that you can look out for. Look at that gap up on Electra Green Tech. It's holding up 6% right now. And JBM Auto, which is seeing a gap up of about 3.5% in an otherwise weak market. But that said, it is a gap down start. Kunal, we've now slipped below the 200 DMA. What next?
Yeah, I think there should be more selling pressure, at least the adjustment for the risk in the last 3 days, because there was some sort of positivity brewing into the indices as well as in the sentiment. So that risk should be tapered off. So I think the first couple of hours till at least 11:30, 12 noon is where the risk adjustment generally happens. So I would probably expect the markets to remain under pressure for the first couple of hours, and then we'll take a call whether there's any major kind of a trades which is emerging as a contra buy on the index as well as on stocks. But the initial stock which I would look to sell would be Asian Paints, the stock showing an incredible amount of indicators getting into an overbought territory. So would suggest a sell as well as go into a shorting over here for Asian Paints.
Yeah. We're just aligning ourselves with the global mood this morning. And I'm just looking at the constituents from within the Nifty Bank. That's where you're seeing the sharpest signs of pain. Look at RBL Bank. That's down 3% right now. Big boys like ICICI Bank are cracking 2% as we speak. Financials like Bajaj Finance, which in any case has been a rank underperformer of late, that's fallen even further. There's of course PNB, Kotak Bank, HDFC Bank as well, which is lower by about 1.6%. Federal Bank, BOB, Bandhan, Axis. You can pick up any bank from within the sector, and that's all falling down. Besides that, of course, there's also Apollo Hospitals, Hero MotoCorp, Reliance, which after that 2.25% crack yesterday, it's fallen another 1.5% right now. So 23.39, just about defending that 23 mark literally for Reliance Industries. iShares is down, technology is down, led by Infosys, and then of course there's L&T as well. And the Adani Group names, by the way, are getting quite whacked in this weak market. So Adani Enterprises falls another 3.5%, and I think besides Adani Green, like Nikunj pointed out, it's all a sea of red. But Rudra, what are the first trades that you're executing looking at this gap down?
See, for me, two things. One is, if you are an aggressive trader, use this opportunity of fall in banks to buy good banks. We are talking about SVC yesterday in America, but look at even top private banks of America. They have fallen, but not like what 60% fall what you saw yesterday in SVC. So what I'm trying to tell is buy quality stocks like HDFC Bank on this dip. You have strong support at 1,580. Look at even ICICI Bank after this fall. From PSU banks, look at Canara Bank, look at SBI. I'm not advocating buying an Yes Bank. I'm not telling you to buy either even RBL Bank or banks such as these. Look at HDFC Bank, look at Canara Bank, look at SBI. Use this gap down as a buying opportunity with strict stop loss. For me today, if I have to pick a trade based on what I see on screen, Bharti Airtel is outperforming in a market like today, and it is a consecutive 2 days of outperformance. I've in fact bought Bharti Airtel now at open, looking at targets of 810. That was also my morning recommendation. Stock is outperforming, so I have a buy call on Bharti Airtel.
Manish Chaudhary joins us now.